Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young. Now, to start this year, 2024, the odds-on favorite was that we were going to see a rate decrease in March of this year because things like the labor markets, i.e. hiring, they were supposed to have slowed, not completely, not to zero, but to a level that the Fed was going to be comfortable with. And of course, we've continued to see inflation just continue its bend down. And all that, along with other things, would give the Federal Reserve the ammo it needed to lower interest rates. And thus, the stock market has been rallying around that theme since basically the end of October of 2023. That's where the market dropped 20% the end of October, and then from there just has gone parabolic. Well, this week, we got information that proved that theory incorrect. And the CME Group, who we've talked about in this video series, they track the probability of interest rate changes. They went from being at over an 80% chance that the Federal Reserve was going to cut rates at their March 2024 meeting to now they think that there's only a 20% chance of that happening. So did this lack of lower rates create a bad backdrop for the markets? Have we seen the markets go down this year? Well, it has for aggressive growth or smaller companies because they require so much bank financing to fund expansion and growth and sometimes even operations that it looks like that bank financing for them will be more expensive. Hence the Russell 2000, which tracks those smaller aggressive growth companies on the year, it's negative 3.14%, while the S&P 500 is positive 3.96. And the rest of the market, the MSCI EFA, well, there's no gain there. India, another international place where we really like, they're up almost 6%. So this recalibration around what is going to happen with interest rates has hit part of the market in 2024, but it's probably only hit one part of your portfolio really hard, and that's the aggressive growth piece. The major reason why I bring this up, why are we thinking differently about interest rates now? Why has that theory changed? Because the economy is constantly providing us data that it is strong, and it's not slowing down. Last week, we told you about US GDP that was up over 3%. This week, we're going to talk about fantastic news around the job and labor market, income growth, and some other economic things and some stocks. But things are trending in the right direction. Now, this is not to say like a major blow up can't happen. Probably the office commercial market is probably one where we could see that. And that could give the markets a scare in 2024. There could be a host of other things we don't even know about right now. But things are progressing well. So let's look at some of the economic data we review each week to understand how the markets are doing. First, we always look at the Atlanta Fed's GDP Now model. This model helps us understand the expected growth of the economy in real time in the current quarter with real economic data. And this week, the Atlanta Fed, after incorporating data from the construction spending report and the manufacturing ISM report, we are now sitting at an expected 4.2% GDP growth in our current quarter. That is fantastic. President Obama, when he was in office, said 2% is the new normal because that's what he consistently delivered during his presidency. President Trump, of course, proved that wrong by delivering robust economic growth throughout his 4 years, and now it continues. After last week's GDP report, and that was for the fourth quarter, the actual GDP report that came out, you can see the average Wall Street economist has raised their estimate for the first quarter, our current quarter, 2024, to around 1.5%. A very impressive number and one that we are going to continue to watch every single week, of course. The initial and continuing claims for unemployment insurance. That comes out every Thursday morning. And this week, the initial claims held tight to their very low range of 224,000 initial claims for unemployment insurance, more than last week and the highest since November of last year, but still very low historically speaking and only slightly above the 2022 average. Additionally, the continuing claims, those that are getting on unemployment and then not coming off, that did spike up to 1.89 million, still around the pre-pandemic number, which was a good economy, as we remember, but not historically low there anymore. To my surprise, even though the rest of the interest rate market took a jump up this week, The 30-year and the 15-year mortgage rates did take a slight bend down, coming in around 6.63 and 5.94% respectively. And finally, the markets this week, how did they do? Well, the S&P 500, which is our proxy for growth and growth in income, but only when taken and considered together, that was positive 1.38%. The Russell 2000, which tracks small and mid-sized stocks or aggressive growth in our Dave Ramsey vernacular, that was negative 0.8% this week. And finally, the MSCI EAFE, which tracks international stocks across the globe in developed markets, excluding the US, that was positive 0.13% this week. Now on to point number 2. Let's talk about the new jobs report for the month of January we received this Friday. The U.S. jobs market showed continued strength in 2024, according to the latest report from the Bureau of Labor Statistics. Non-farm payroll employment rose by 353,000, which was similar to December's gain. They actually got a revision upward, pushing the unemployment rate to 3.7%, matching the record low set in December of 2023. Unemployment remains under 4% for 24 months now, 2 years and counting. That indicates a robust labor market with high demand for workers. And the job gains in this report, I loved it because it wasn't government. You know what it was? It was sectors like professional and business services. Those were up 74,000. Healthcare workers were up 104,000, and retail trade was up 45,200 jobs. Experiencing significant growth across those sectors was wonderful. There was a sector that had contraction, that was mining and oil extraction. They saw job losses for the quarter. Now, also in this report, we got pay increases. Are people getting paid more to be employed, which are part of the same report? Year over year, pay gains for job stayers, those that did not switch a job, reached 5.2% in January, down from 5.4% in December. And for job changers, pay was up 7.2%, the smallest annual gain for them since May of 2021. Overall, annual pay was up year over year, which is a positive sign for things like consumer spending, which is 2/3 of our economy, which means the economy should benefit from this. However, this also represents a slowdown compared to previous months, and that's good for inflation because the reality is you can't have too much wage growth because it'll spur inflation. How about an industry breakdown as it relates to the wage gains? Well, those varied across sector. Leisure and hospitality, which saw the highest jump, they went up 6.3%, reflecting continued demand in the travel and leisure, vacation industry. Construction pay went up 5.6%, and professional and business services went up 5.1%. So strong growth there. On the other hand, mining and oil extraction, job losses and pay decreases down. Job stayers versus job switchers. How about that? Interestingly, the pay premium for those that switched their jobs shrank to a new low, suggesting that acquisition costs might be stabilizing for new employees. This could impact things like recruitment strategies and potentially lower companies with lower turnover, and that's good for productivity of workers. And how about regional differences? Median pay growth range across states, with the highest increases happening in the West and the South. No surprise there, demographics equal destiny. How about point number 3? 2 stocks that are important to many investors and our clients alike are Apple and Facebook, or their parent company Meta. They both reported earnings this week, along with many other tech stocks. And Apple, for the first time in a year, posted a year-over-year increase in revenue, coming in around $120 billion, which was up 2.1% from a year prior. Their net income was $34 billion, which was up about 13%. And their all-important iPhone business, again, the most important business to them, grew. And that's important. One reason that Apple has been lagging behind the broader large company technology market is because it's not been out ahead of the artificial intelligence game like it seems Microsoft, Google, Facebook, and NVIDIA have been. However, on this call, CEO Tim Cook did say that he'll be announcing some of their AI plans and investments later this year. You've got to think that Apple has not been sitting on the sidelines of the AI boom. They just haven't told us what they're doing yet. But there becomes a point you got to tell us so the market knows you're in the game. They also announced that their third largest market, China, has taken a 13% decline in sales thanks to stronger local competition there. And finally, their first major product launch in nearly a decade, I'm excited about this. The Apple Vision Pro will start shipping to clients this quarter. And this is a virtual reality headset. And in my opinion, only here, this is going to revolutionize the way we do business and the way that entertainment is done. And a strong, strong reason to stick with Apple if you're an investor. Next, Facebook probably had the best earnings announcement ever, at least by market capitalization growth perspective, because they added $204 billion in value in a single day, and that is the most ever in a single day. They also announced that they'll buy back about $50 billion in shares, and they're going to start paying their first ever quarterly dividend, presumably making them eligible now for growth and income funds. Now, you'll find stocks like Apple and Microsoft in both growth and income funds because they're growing at a torrid rate still, but they also desire to return capital to shareholders, and now Facebook's going to be part of that group. They reported a 25% gain in sales and showed profits had tripled. Thankfully, both Apple and Meta are in the Whitaker-Myers tactical portfolio, which is a portfolio we buy for clients that want individual stocks if they request that and want that. And they proved why they're in there this week. And finally, point number 4. In case you didn't hear, China's Evergrande Group, which was at one point their largest property developer, has been ordered by a Hong Kong court to liquidate its assets. China's Evergrande Group is just the latest in a series of developers that have been collapsing in China's beaten down real estate market. Evergrande, as I said, they once held the title as China's largest real estate developer by sales, which is why this is so important and newsworthy. And creditors, they've been, based on what they've been telling the courts, they've been arguing that Evergrande, who's supposed to be negotiating with them in good faith, have not been doing that. And so now the court orders them, hey, you got to sell your assets, and the creditors will take over these assets, start selling them. Now, what happens when a distressed market like China's real estate market has assets come online with a lot of supply? Well, more downward pressure on prices, further hurting the Chinese economy and their real estate market. And with prices falling like a rock, guess what else happens? Tax receipts are following in order, taking a large source of revenue from Chinese local governments. In our opinion, investing internationally should be done in a tactical nature and in places with stronger demographic and economic realities than China. Some places we really like, well, we talked about it a little bit earlier. India is one that we just feel like has demographic trends that are some of the best in the world, frankly, and has a strong economic backdrop that, of course, we can go out or discuss with you to help understand why that 0.25% that you typically want internationally, it should be done, again, very thoughtfully. And China's Evergrande Group and their entire real estate market is proving why that is the case. China takes up a large percent of most international funds because of their size. Thus, most international funds struggling, as I said earlier, the MSCI EAFE, which technically doesn't include a lot of China because they're an emerging market, is flat on the year. And so if you would like to talk about your situation with any of our financial and coaches and advisors, well, definitely go to the comment section of this video and you can click on that. Our financial coaches help you in baby steps 1, 2, and 3. Get out of debt, stay out of debt, live debt free, and hold you accountable to your budget and your debt payoff goals. And our financial planners and advisors help you in baby steps 4, 5, 6, and 7. Start implementing your retirement and or investing plan for any other goals you have, as well as helping you path yourself up to baby step 7, where you can live and give like no one else. As well, you can always do us a favor by hitting the like button on this video. The like button helps us, or helps tell Google, YouTube, and Rumble's algorithms that our content is helpful, and thus pushing it out to more people. And the subscribe button allows you to get our videos as we release them each and every week. Thanks so much. We'll look forward to seeing you next week on What We Learned in the Markets this week.